Hello, and thank you very much for the opportunity to present our study titled The Performance of SRI in Meta-Analysis. This paper is joint work with Lars Hornhoff. Let's start with our motivation. So socially responsible investing, SRI, consider financial returns and the impact on environment, social conditions, and governance, so ESG. There's an increasing interest and market for SRI. 2 years ago, every third US dollar under professional management in the United States, which was 70.1 trillion US dollar in total, was managed according to sustainable investing strategies. But classical finance theory predicts underperformance of SRI because of the limited investment possibilities. Like Friedman already said 50 years ago, the only social responsibility of business is to increase profits. However, empirically, the performance of SRI is not really clear. For example, a few weeks ago, a record demand for the UK's Green Gilt was recorded, which was the largest green bond issue ever, and the green bond was priced at a yield of 0.87%. So our goal in this paper is to give empirical evidence for SRI performance using a meta-study on SRI studies. Therefore, we compare SRI funds, stocks, and bonds to a market portfolio and explain empirical evidence of SRI performance. I would like to anticipate our results so that you can better control the derivation later. So first of all, we find no difference in the performance of SRI compared to the market portfolio. SRI tend to perform better when investors invest globally. Furthermore, in case of SRI outperformance is reported in studies, it is because those studies are published in journals with lower impact factors or by authors that do not publish frequently. Researchers who publish in peer-reviewed finance journals more often report SRI underperformance. And lastly, we do not find research methods that affect outperformance of SRI. Coming to our first hypothesis, like I already mentioned before, according to the modern portfolio theory, investors can benefit from diversification. However, the SRI investment universe is limited and it is a subsample of the market portfolio. Therefore, we follow the underperformance hypothesis that states that investors should expect worse performing mean variance portfolios when they support only firms that attach great importance to ESG criteria. So our first hypothesis is that SRI underperformed the market portfolio. It is possible to benefit through diversification, meaning that investors invest in international investments. In the crowdfunding literature, there is a local bias, and you can see that investors prefer regionally close investments, even though these local portfolios underperform. The SRI literature also reports outperformance for global portfolios. A study in our database compares domestic and international SRI to conventional funds in Australia. And they show that SRI outperforms when they consider international, so diversified funds, and underperformance when they consider domestic SRI funds. Therefore, our second hypothesis is that studies examining global SRI portfolios report better SRI performance relative to studies that examine regional SRI portfolios. In our paper, we formulated several hypotheses related to journal information. First of all, the impact factors provide information about the influence of a journal, and prestigious journals have high impact factors. Secondly, more renowned scholars like Miller and Farmer follow classical finance theory and publish in highly ranked journals. We therefore assume that following classical finance theory enables researchers to publish articles in peer-reviewed finance journals. So our third hypothesis are studies that are published in journals with a higher impact factor are less likely to report outperformance of SRI. B, studies that are published in finance journals are less likely to report outperformance of SRI. And C, authors that publish more frequently are less likely to report outperformance of SRI. Our last hypothesis states that more factors make it more difficult to explain outperformance in a model compared to less factors. Humphrey and Lee report different results when they compare SRI to conventional investments and use different factor models. They show SRI outperformance when they use Jensen's alpha and underperformance when they use Carhart's alpha. So we hypothesize that studies considering more factors are less likely to report outperformance of SRI. Now let's come to our variables. So in general, the SRI literature is extremely heterogeneous and the methods for performance comparison vary across the studies. With our dependent variable, we want to find out if there is SRI outperformance. So we have for the OLS model percentage difference of SRI and the market portfolio to make these methods comparable. The dependent variable of our probit model is a dummy variable for outperformance, that is 1 if SRI outperforms, so SRI minus the market is positive and 0 otherwise. To test hypothesis 1, we compare the mean performances of SRI minus the market portfolio. We start with simple mean returns and then go on with excess returns, so the difference between an asset and a risk-free investment. We further compare other returns like the 4-factor adjusted abnormal returns. Next, we have risk-adjusted measures, which include Sharpe ratio, trainer ratio, and so on. Furthermore, we compare alphas of factor models as well as market timing models. Then we have the category efficiency, which includes data envelopment analysis and free disposal hull. So the DEA uses input variables, for example, the risk level or investment costs, to form output variables like the mean returns. And the model measures investment performance and evaluates efficiency. And the FDH is a non-convex version of the DEA. And lastly, we consider SRI regression coefficients. To test our second hypothesis, we use a dummy variable global, which is 1 if global investments are considered in a study and 0 if not. To test hypothesis 3A, we consider the 2019 journal impact factor. And we have a dummy variable finance journal, which is 1 if a study is published in a finance journal and 0 if not. To test hypothesis 3B. And for H3C, we have the number of studies one author has contributed to our data set. And to test our last hypothesis, we use the methods for performance evaluation that I showed you on the last slide, except for mean returns. And therefore, we have different dummies for each category. Furthermore, we included several control variables that are in line with previous literature. These are sample period, matching procedure, investment type. So is it a study that considers stocks or funds? Then the benchmark, survivorship bias consideration, and databases. Now let's come to our data set. We searched for several keyword combinations, including SRI, ESG, and SEE, which is social, environmental, and ethical in Ideas, Science Direct, and Google Scholar. We found in total 5,845 studies, which we all screened, considering following inclusion criteria. First of all, the studies need to be academic studies, so we do not distinguish between published and unpublished studies, but we deleted all student research projects. Then the study needed to be an econometric study, so all narrative papers were deleted. And for our meta-regression, the performance measure was necessary, so we needed the comparison of SRI versus conventional. The studies also needed to include enough data regarding SRI funds, stocks, or bonds, then the sample periods and regions. And lastly, all studies included are in English language. So in total, we considered 155 studies and 1,047 observations for our analyses. Some studies, or almost all studies, were coded multiple times because of different regions, sample periods, and methods used. So to test hypothesis 1, which is SRI underperformed the market portfolio, we compare the mean performances. In this table, you see you do not see the SRI and the market values, only the differences for funds compared to the market portfolio. And in total, we have 96 studies and 510 observations that can be compared. Every single performance measure reports negative difference, which is SRI minus the market portfolio. Only the difference in alpha is positive, but both groups were negative, which means that SRI funds and the market portfolio both underperformed the conventional counterpart, but SRI funds outperformed by 1.8% annually. So in sum, we can say that there is no difference in SRI funds and the market portfolio. We consider 25 studies and 156 observations to compare the performance of SRI stocks to the market portfolio. Even though we can see that almost all difference in means are positive, we again see no significant difference between SRI stocks and the market portfolio. We also compared SRI bonds to the market portfolio, but we won't further consider them because of the small sample sizes. So to test our second hypothesis, which is that studies examining global SRI portfolios report better SRI performance relative to studies that examine regional SRI portfolios, we use the variable global. And we have 5 categories for region in our data set, which are Europe, USA, Asia, rest of the world, and global. Here in this table, Europe, or in our regressions, Europe is the baseline. This table reports the model results of the main regression, funds and stocks, in the first 2 columns, and then funds only in the last 2 columns because it is the largest sample size. So in case of global, we expected a positive sign to show better performance compared to the baseline Europe. And the OLS model in the first column indicates that investing in global portfolios increases SRI outperformance by 52 percentage points compared to investing in European portfolios. The Probit model reports average marginal effects, and here is no effect for investing in global portfolios compared to European. But in the last 2 columns, we see that both models for funds show significant differences for global compared to Europe. So our results are in line with hypothesis 2. To test hypothesis 3A, we considered the impact factor. The results for impact factor support our hypothesis 3A that outperformance of SRI increases when the impact factor decreases. So if the impact factor increases by 1 unit, SRI outperformance decreases by 14 percentage points in case of the OLS model. And for the Probit, it reports a 6% lower probability of SRI outperformance. So our result 3A is a higher impact factor decreases the probability of SRI outperformance. The same holds true for publications and finance journals. To test hypothesis 3B, we consider finance journal. The coefficients are again negative. So observations that are published in finance journals decrease the probability of outperformance of SRI compared to observations published in non-finance journals. And in our data set, or in the sample, 37% of the observations are published in finance journals. We also find support for hypothesis 3C that authors who publish more frequently are less likely to report outperformance. We further test the effect of the highest number of publications by one author on the publication in peer-reviewed journal. And in our sample, the value for the publications by one author ranges from 1 to 7 and has a median of 2. And Therefore, we have a probability of publishing in a peer-reviewed journal with at least 2 authors is 80%, and the probability to have a study that is not published in a peer-reviewed journal with less than 2 authors is 70%, and the 2 sample t-tests shows significant difference between these 2 groups. For hypothesis 4, we use SRI score here as the baseline, and concerning the consideration of more factors in the performance evaluation, the results of our meta-regression are not consistent with hypothesis 4. We would have expected negative coefficients in these cases. Now I'd like to show you some additional findings of our meta-regression. First of all, due to the increasing market for SRI, we would have expected a higher probability of SRI outperformance when more recent data sets are used. We can find support for this assumption when we compare the sample period 91 to 2000 to the baseline, which is 81 to 90. The probability of SRI outperformance increases by 57 percentage points if a study uses the sample period 91 to 2000 compared to the older sample period. And model 2 reports that the probability of SRI outperformance increases by 18%. We do not find any effect when more recent data sets are used. However, this could also be tracked back to market anomalies. So once SRI has outperformed, investors made huge investments, then the effect diminished and disappeared. Next, when we look at peer-reviewed journal, we see positive coefficients, indicating that reporting outperformance is more likely in peer-reviewed journals compared to studies not published in peer-reviewed journals. But like I already mentioned before, the peer-reviewed journals are those with lower impact factors. And lastly, when we look at databases, we can see when studies use Bloomberg data, the probability of underperformance of SRI increases. And for databases, our benchmark was other data. So now I would like to tell you again our key takeaways of our paper. And again, there's no difference in SRI and the market portfolio. SRI perform better when investors invest globally. And in case of SRI outperformance, it is because studies are published in journals with lower impact factors or published by authors that do not publish frequently. And then researchers who publish in peer-reviewed finance journal, more often underperformance of SRI is reported. And lastly, we do not find research methods that affect outperformance of SRI. So thank you very much for your attention.